In January 2025, the S&P 500 jumped 2.7%. That's more than double the average January return, and historically a sign of good things to come. The last time we saw a January this strong was in 2023, leading to a 24% rally over the year. But this year, things look different. After a promising January, the market went on to lose over $5 trillion in value in just a few weeks, amidst tariffs and trade war uncertainty. The S&P fell more than 20% from February's highs, briefly dipping into bear market territory and reigniting fears of a recession. So, did January lie to us? There's an old saying on the stock market, as goes January, so goes the year. It refers to a seasonal signal traders love to watch, the January Trifecta. It combines three market indicators: the Santa Claus Rally, the last 5 trading days of December and the first 2 of January, the first 5 days of January, and the January Barometer, the full month S&P return. It may sound overly simplistic, but it has an impressive track record. When all three are up, it's historically a bullish signal for the year ahead, and vice versa. For 2025, 2 of the trifecta's 3 indicators are up, and 1 is down. Here's what that might mean for the year ahead, and also why we might want to take these numbers with a grain of salt. For example, in 2023, we got a full trifecta. The Santa Claus Rally, January's first 5 days, were up, and the January Barometer returned an outstanding 6.2%. Sure enough, the S&P went on to rally 24% that year. But in 2022, the trifecta was mixed with a 5-point loss in January. And true to form, the S&P fell nearly 16% over the rest of the year. But like with most rules in the stock market, there are some exceptions to take note of. For example, 2018 had a full trifecta and a stellar 5.6 return through January, more than 4 times higher than average. But despite the positive trifecta, the rest of the year, February to December, was down 11%. The opposite happened in 2016. The trifecta was all negative, but the S&P returned over 15% from February to December. These exceptions are a reminder to take the trifecta like any indicator, with a grain of salt, and in conjunction with other indicators to form a complete and well-rounded picture of market conditions. Now, in 2025, the results are in, and signals were mixed this year. The Santa Claus Rally was down 0.5%. But the first 5 days of January were up 0.6%, and the January Barometer was up 2.7%. So what could that mean for the rest of the year? Well, there are a lot of factors muddying the waters. Tariff uncertainty and an ongoing trade war threatens margins and higher inflation. The Fed's latest tone suggests higher for longer interest rates, which would stifle growth. And there's the recent downturn that dipped briefly into bear market territory in early April. But despite all this noise, we might still glean some insights from the trifecta. The most important of the 3 is the January Barometer because it encompasses the biggest chunk of time. And since 1929, when January is positive, the S&P is 31% more likely to go up the rest of the year than when January is negative. And those returns were bigger on average, 8.3% versus 2.1% when January was negative. So, with this year's positive January, that bodes well. But we still need to zoom out and take other factors and signals into consideration. And the correction we're currently seeing, coupled with economic headwinds, raises big questions about whether this year might end up being an exception to the rule. But there's another angle to January's signals that gives us some guidance on the year ahead, and that's by looking at which type of stock led the month. By stock type, we mean large growth, large value, or small value companies. The Luthold Group finds that January's style leader in these 4 categories tends to outperform by an average 3.6 percentage points over the rest of the year. In 2025, large value stocks led with a 4.6% gain, while large growth lagged, up just 2%. If the tendency pans out, that would mean that large value stocks have a higher likelihood of outperforming in 2025. And if we look at the Vanguard Megacap Value ETF versus the S&P 500, we can see that large cap value stocks haven't been hit quite as hard as the rest of the market. But again, this is not a rule, just a tendency. The January Trifecta is a reliable, data-backed tool with an impressive track record, but it's not a crystal ball. The current market correction reminds us that there are so many different macro factors that move the markets, and no indicator should be taken by itself. Tariffs, Fed moves, and earnings will be key factors in how the rest of the year pans out for the stock market. But the trifecta and the January Barometer are still useful signals about where the economic winds might be blowing for the rest of the year. At Capital.com, we'll keep unpacking the data and trends that really move markets. Subscribe for more breakdowns like this. Thank you for watching.